Good afternoon, everyone. Welcome to today's webinar, Expert Insight on LLP's Formation, Conversion, Compliance, and Winding Up. On behalf of the Corporate Laws and Corporate Governance Committee, on behalf of our Chairman, C. Debashish Mitra, past President, ICAI, and current Chairman of the Corporate Laws and Corporate Governance Committee, we welcome you to this webinar. We are very happy to have you join us for this insightful session where our expert will delve into the essential aspects of limited liability partnerships. From the intricacies of setting up an LLP to navigating conversions, ensuring compliance, and managing the winding up process, we will be covering each and every aspect. Today, we have with us for this webinar, CA Kusai Goawala sir. A brief introduction about sir, if I would have to give. He's a fellow member of the Institute of Chartered Accountants of India since 1986. He has got 37 years of experience. He has lectured on topics such as tax audit, IFRS, Ind AS, auditing standards, company law, GST at various forums. He has contributed to various publications, including Guidance Not on Internal Audit. Thank you so much, sir, for accepting our invitation to take up this session. Over to you.
Thank you very much, Seema Madam. And also want to thank the committee for giving me this opportunity of presenting this particular seminar. My learned professional colleagues, a very good afternoon to all of you. And let me first share the screen, the PPT, and then we will start the topic. Dear friends, this limited liability partnership is been there since about several years, and I believe most of our chartered accountants and members are already conversion with the kind of intricacies which we are dealing with LLP. And today we are going to, in about next 2 hours, we are going to cut across this entire ambit of LLP as to what it represents, how do we utilize this maximum benefit of this particular LLP format, and how it helps us in furthering our business advantage. That is what we are going to discuss in the next 2 hours. People who have heard me earlier will know that I believe in going into the root concept of each and every topic. I'm not going to just bombard you with the technical sections and say that, okay, these are the sections you just understand. No, that is not the objective. Because if I do that, then probably after a few hours, you will forget. My objective is to make you understand this concept for life. And for that, I will take you to the bare concept of each and every aspect of this LLP partnership, act, the law. And, I will explain you the why of each and every item as to why a particular provision is being introduced and how do we deal with those provisions. I will also share my practical experiences which we have faced during the last several years when dealing with this LLP, as well as pre-LLP stage as to what were the difficulties faced and how this LLP has been able to resolve those kind of difficulties. And we will, in detail, go into the practical aspect as to how one has to deal with this LLP aspects. So this is our agenda for today. The agenda is that what is the benefits of LLP? I'm sure everybody must be aware about it, but I will just need to explain you in detail so that whatever subsequently we are going to discuss will become easier, because I believe in the principle that it should be a total overall 360-degree view of the entire LLP profile. So we will explain about the benefits of LLP, then how the LLPs have to be incorporated, how do you deal with the contributions and the audit of the LLPs, how are we going to do the compliances under the LLP Act. Significant beneficial ownership has been a new amendment in the particular area, and we will discuss. This is the most complex and intricate aspect of it. We will discuss in detail with examples as to how do you deal with this, because many people are still not aware about this SBO. And I have observed in my practical life also that many of our members are also not aware about this particular provisions, and they are not even complying with. And many LLPs are not even complying with those kind of SBO provisions, and they are incurring penalties because of non-compliances. So this we will discuss in detail as to what it means. Then there are various provisions under the LLP Act regarding the compromise and arrangement, which are similar to the Companies Act. And I will take you through those procedures as to how do you deal with that. Then, if you want to close down the company, if you want, sorry, LLP, strike off, or maybe it's a winding up or dissolution, how do you go about doing it? What are the pros and cons? We will discuss that. Of course, any act, anything which you don't do, there are penalties which is levied by the regulator. And how do we, minimize our impact on penalties? We will have to see, because we have to comply with those laws and avoid penalties. That is the objective, because penalties are expensive. And the last but not the least, LLP has got certain income tax angle also, and we will discuss in detail about certain intricacies of income tax. Though that is not the main area objective of this entire session, but we will also give you as an additional bonus as the income tax aspects. Like, when we are, I always share this with my colleagues, is that whenever we go and eat pani puri, the last we always ask for one extra puri, and this is that extra puri which we'll ask for, and that which I'm going to give you is that income tax angle. So let's look at the benefits of an LLP. Now, why LLP? That is, question comes in our mind as to why do we need an LLP? We were already comfortable with partnership firms. We were comfortable with private limited companies. So why this new angle of an LLP? What does it? How does it help us? Now, see, before LLP was introduced, people were smaller entities, smaller businesses, partnership. Those family-owned businesses were comfortable doing businesses in the partnership and a proprietorship concern, because the compliances were minimum. They didn't wanted to get into the gamut of corporate culture, and they didn't wanted to do compliances with a company's type. And so they were comfortable doing business in the partnership style. A very old traditional business is going on, and they were comfortable only filing their income tax return, and they were happy about it. So, but the challenges keep coming up. And when the challenges come up, the economy, the businesses, the world around, everything changes, the global impact. Now, things happen that, they started getting claims, and, the liability started pouring into the company. Those partnership firms, the proprietor, which not only stopped at the partnership firm level or at the proprietor level, but because it exceeded the assets of this partnership firm or the proprietor's assets, and then it went down to their personal assets. And that's where the pinch started for. That they realized that their personal assets are also at stake and jeopardized. So it was important that they wanted a limited liability angle. So they even started switching over a small family-owned companies, family-owned businesses. They started switching over to the private limited companies, which were actually a glorified corporatized partnerships. When they started doing that, they also realized initially companies in the 1956 Act, it was quite simple, and the compliances also were very simple and easy, and they could get away with those kind of compliances. But when 2013 Act came, a lot of new compliances came up, a lot of new intricacies came up, and at that stage they realized, no, it's very difficult to do business in the private limited company model, because they have to hire some professionals or senior people just to do the compliances, and the time, instead of spending on the business, they were spending more time on the compliances. So they found it a little unproductive, and they realized, we have to come out, because our businesses are very simple and small, and we don't have that kind of infrastructure to do this kind of compliances, and one small miss out of compliances would result into huge amount of penalties. So they were looking for some avenues where they can get that same benefit of a limited liability of a private limited company, a corporate entity, which they want because they want to do business. So they have to show up a corporate, identity. And for that, now this limited liability has come and given them that exact whatever they wanted. That has got a separate legal entity, because it is not something to do with the partnership. See, if you know the partnership law, and even in income tax law, if there are two partners in a firm, and if one partner dies, so the firm dissolves, automatically dissolves. There is nothing to be done. That becomes a proprietary concern, and the firm dissolves. And under the income tax, there was one very, very severe provision under Section 45, that all whatever the assets of the firm, they are liable to capital gains in the hands of the partner, and that was very expensive. So, which doesn't happen with an LLP. It has got a perpetual succession. Even if there are two partners and one partner dies, for 6 months, you can get another partner. So there is always a provision. It doesn't automatically become, the LLP doesn't get dissolved automatically on death of one partner when there are only two partners. So this is an advantage. It gets a perpetual succession like a company. A company doesn't, die or dissolve, or even if that out of two shareholders, one shareholder has expired or something, the heirs and all that come into place. So all these provisions are there under the Companies Act, which was not there under the Partnership Act. Now this LLP Act has given that buffer, and it's like a mean between the two, between the partnership firm and a private limited company. The disadvantages of a partnership firms were avoided, and the advantages of a private limited company were taken over here. Similarly, there were advantages of a partnership firm, which again the LLP has got it, and advantages of a private limited company also has been brought into the LLP. So now it is a win-win situation. It is something which is like the one of the best mix which you can get. So LLP is something which is the mean between the partnership firm and an LLP and a private limited company, and a business can be done easily without any much of a compliances. They are very simple compliances. Some compliances are still there, but they are much more simpler compared to a private limited company. We will once we go into it, we will deal with it. What kind of compliances you don't really have to go when you do a LLP. No minimum capital requirement. You can start with 50,000, 10,000 capital requirement, and there is no need for bringing in minimum capital. Of course, in the private limited company also now, earlier there was a limit of 1 lakh capital. If it goes below, then there is a problem. But now that is not there. You can even have a company with 200 rupees capital, but of course, subsequently you'll have to increase it. But there is no minimum capital requirement in respect of LLP. Pass-through taxation. It is the most interesting point. In a private limited company, the company pays tax first. And after that, if the profit has to be distributed, it is taxed in the hands of the recipient or the shareholder as a dividend. And that is again very expensive. So the effective tax rate goes up to almost about 50 to 55%, depending on what slab the individual is in, because now the individuals are at a higher slab, 37% also in some cases. So that situation, it becomes tax ineffective and inefficient in terms of the private limited company, whereas LLP, there is only one-time tax. Once it is taxed, whatever is the profit is left out to be distributed, that does not bear another tax. So, of course, the lower complexities and the compliances has make it more attractive because it is more simple to operate and easy to manage in terms of compliances. Now, just to compare between LLP and a private limited company, we have already discussed a little bit, but again, to add up on that, the LLP is a general simple formation compared to a private limited company. The formation procedure is much simpler. The LLPs do not have a share capital, and there are no restrictions on transfer of ownership of interest. Whereas in the private limited company, you have to do that share transfer. You have to give first notice to the existing shareholders and all that kind of thing. Of course, here one very interesting, one important thing is there. Okay, when in the private limited company, when the shares are transferred, of course, a private limited company, the notice has to be issued to the other shareholders whether they are interested in buying those shares, and if they don't agree, then only it can be sold out to the third party. That is, of course, depends on the articles, if the articles are providing. So in LLP, you will still need the partner's consent and also the signature when you are amending the deed, because all the partners will have to sign that LLP deed and register with the Registrar of Companies in order to give effect to the change of the partners. So this is one thing which is not there in the private limited company, because if the share changes, the other partners are not required really to sign off. They only have to give consent at the beginning whether they are willing to buy the shares or not buying shares. That is first thing. But if they agree not to buy, and if they are willing to, that person can be allowed to sell to anybody, then transfers are very easy compared to in case of a LLP. Pass-through taxation, I have already explained to you. Taxation is at a lower level, but of course, in a private limited company, some of the companies enjoy a tax rate of 26%, inclusive of surcharge and cess. Whereas in case of LLP, it can go up to 33 to 34%. So there is a slight higher tax rate, but then whatever is left out after that is not again taxable. So effectively, in overall scenario, yes, it makes sense to, I mean, it's a tax efficient structure. But of course, now if some private limited company doesn't want to distribute a dividend, they want to plow back into it, then for them, the private limited company would be definitely more efficient in terms of the tax. Now, as far as a partnership is concerned, we all know that a partnership has got an unlimited liability. Of course, very simple to form. Just make a small partnership deed. You don't have to go for any name approval, anything. Just form whatever name you want. You form a partnership firm. Apply. I mean, file it with the registrar of firms, and that's it. That your work is over. Now, here also again, the point is registration of the firm is also not mandatory, but still people would prefer to do it because otherwise litigation will be a problem. You cannot file a case against anybody unless it is a registered partnership firm. So you will have to register it with the registrar of firm, but that is a very simple process compared to the registration of an LLP. But apart from that, it has got a disadvantage in terms of unlimited liability. But of course, see, now when you're looking at unlimited liability, any entity, whether it is a private limited company which has got a limited liability, LLP also which has got a limited liability, when they approach any bankers or any financiers for a loan, they will always ask for a personal guarantee of the partners or directors, and there your personal assets are already captured. So, I mean, there in that situation, your limited liability will not really help you because you have given a personal guarantee. So, if tomorrow the LLP or the company is not in a position to meet that liability, your personal assets will get impacted because you have given a personal guarantee, and no bank will give you a loan unless and until the directors or the partners have given a personal guarantee to the bankers. So to that extent, you don't really have any safeguard. It's the same whether it is a partnership firm or a private LLP or a private limited company. But claims from the third party, business claims, for suppose when you're doing a business, there could be some problems, and the claims come from a customers, and those claims can be huge. It can wipe out your entire network. It can wipe out your entire asset base, your personal assets also. So in that situation, you are protected and it doesn't travel to your personal assets. Now, there are also one thing is that the statutory liabilities. There has been instances I have observed in my past practice that the government will move. Suppose if they are not able to recover the money from a private company or a LLP or a partnership firm, they have gone into their personal bank accounts of or assets of the partners, so or directors. So because they are considered as responsible for complying with the statutory requirements, and if they have failed to do that, then they will be personally liable. So there are provisions under those respective acts where they can be held liable and they have to make good those payments. So there again, there is no safeguard. Even whether irrespective of your limited liability, you will be liable because there is a statute only in respect of those business claims and which we can get protection, and that is an advantage. It has got a separate legal entity, so which partnership firm doesn't enjoy. When suppose if an asset is owned by a partnership firm, it is basically considered as a jointly owned assets. That means suppose there are four partners, all four partners have to sign in order to sell that asset. Otherwise, the asset cannot be sold. Whereas in LLP, it doesn't work that way. They've got a separate corporate entity. It is considered as a body corporate under the Companies Act. Section 20 of the Companies Act, classifies it as a body corporate. So once it is a body corporate, then it has got a distinct separate legal entity, and it can buy its property in its own name, it can sell property in its own name, it can sue anybody, or it can be sued. So this is something which is not there for a partnership firm, and this is an advantage in the LLP where it has got its own entity. Now, traditionally, the question of joint and several liability, which I've already discussed. Now, they only have to, what the LLP, the partners are required is to contribute whatever they have committed in that LLP agreement. If they have committed 1 lakh rupees or 10 lakh rupees, that capital they have to bring in. That is their liability, not beyond that. unless what I told you, if they have given a personal guarantee or there are statutory issues, or if there is a fraud committed by those partners, then yes, they will be personally liable. If there is a liability on account of a fraud of a partner, then they can be made personally liable, but not otherwise. Because then they have to prove that yes, it was, and see if there is a fraud, then you cannot, you can't pardon them because it's a guilty mind, and it's some, we are talking about those kind of claims where you are not really at fault, but you are victim of circumstances. So in that situation, you are protected. So if, and again, in case of a LLP, it offers a very straightforward mechanism for transfer of ownership interest and compared to the traditional partnership. Now, okay, we go into a situation as to how do we incorporate an LLP. Like LLP is also, coordinated, and entire operations are being, done on the ROC side, MCA side, and ROC is the regulator, the MCA is the regulator, which which they're regulating for companies. It is a similar regulator, so it is also all the forms, everything has to be filed on the ROC MCA portal. So it is similar with whatever you do with the companies. First of all, before you start incorporating process, you must ensure that all the partners or whoever is a designated partner should have a DSC for signing of the documents. Without that, you cannot really upload any documents. So you have to, all the documents are online, and you need a DSC for signing of those partners. DPIN is what needs to be availed. I mean, now DPIN is basically for LLP. We know DIN is for a director's identification number for a company, and DPIN refers to the designated partners identification number. And so whenever a company is, I mean, LLP is being incorporated, you have to identify two designated partners who should be individual. It cannot be any non-individual cannot become designated partners. Suppose if the body corporates are the partners in the LLP, then they have to nominate anybody, any individual who will become the designated partners representing those body corporates, and they should have a DPIN. Now, it is quite possible that now it is a new setup, and they have not they have never been a director of any company, or they were never partners of LLP. Even the DIN of a company is valid. Suppose if they were a DIN as a director, that is valid as a DPIN. So you don't have to again apply for DPIN. If you have a DPIN, then if you have a DIN, then you don't really need a DPIN. It's valid. But if you don't even have a DIN and don't even have a DPIN, then there is another option. Either you apply for DPIN first and get it, or when you apply for the incorporation, DPIN is automatically allotted for at least two designated partners. It will automatically allot DPIN also simultaneously. So this is like one window system where everything is available. Like even when you are applying for this incorporation, your PAN, TAN, everything is automatically allotted. You don't have to again apply for PAN. You don't have to apply again for TAN. The similar is the process even in the company's case. Okay, when you file the company's incorporation form, you get all, in fact, including the GST number. But in LLP, you don't get the GST number. You will only get PAN and TAN. GST number you will have to apply again. In fact, in the company incorporation, you can even have a bank account, designated, and the bank account will be opened directly. So there is an advantage, and there's now the kind of consolidated form, one window system where one form and everything gets done. You don't have to continuously apply after to get certificate, then you again apply for GST or whatever. But that is in case of LLP, you get your PAN, TAN immediately, and even DPIN if they are not allotted for those designated partners. As I said, you need minimum two designated partners. Now, what is the difference between a partner and a designated partner? We will discuss little later in the slides, and I'll explain you what is the difference between those two. I'm sure many of our members must be already aware, they must be operating LLPs, so they must be thinking these are all basics things. But as I told you, we have to start with the basics, and then we will reach a level where it will be advanced, and those advanced cannot be explained unless until you know the basics. Like foundation is strong nahi hai, to फिर वो building का मतलब नहीं. So that is the reason I'm trying to build up the foundation. So it's quite possible that some members might not have dealt with basics of LLP, and for that benefit, I'm discussing all this. Now here there is very interesting object clause. The object clause, of course, has to be for a business that the LLP proposes to follow. But here, if the moment you put in any finance activity in the object clause, then you need RBI approval, prior approval before this object clause will be approved by the MCA. Otherwise, they will not approve this finance clause, because an LLP conducting a financing business first will need RBI approval. They will not allow any financing activity unless and until RBI has permitted. There is also one more thing. We all have seen in the corporate structure section 8 company, that is the charitable objects. Now, a company can be formed with a charitable objects, and it can be registered on the MCA. Whereas in the LLP, it cannot be registered for the non-profit organization or for charitable purposes. It can only be incorporated for business purposes and not for any non-business purpose, non-profit purposes or charitable purposes. So this is a difference between a corporate structure and a LLP. That in company you can have this advantage, in the LLP you don't have that benefit. But generally LLP is used as a business model and not for charitable objects. Now, the objective is very simple, that when you are doing charitable cause, there are a lot of compliances which is important. And in LLP being minimum compliances, they have not provided so many compliances. This angle is not being allowed, because for charitable objects, which is the public domain and it's the public funds which you are dealing with. So in the corporate structure, there is a much more vigil mechanism is there. There are a lot of strict controls are there, which is not existing in the LLP structure, and hence they have not permitted. This is what my reading is. They have not permitted this charitable objects in the LLP. So, and as I said, when we have to apply for LLP incorporation, there is a name approval also is required. Now, the name approval, there are certain, like in a similar process as far as the company is concerned, we have to apply for a name approval. Undesirable names will not be allowed. Like what I mean, I've got a list of what are considered as undesirable. The next slide we will discuss that. And if it is identical or too nearly resembles any other company's name, or any even company or an LLP's name, then that will not be permitted. For example, suppose if you were to register with a name called JK Industries, and if there is a J.K. Industries already there, then you cannot have JYKY Industries, because it resembles that JK Industries. So they will not permit you, although both are different in terms of the how it has been spelled. But no, it is, since it is sounding same, it will not permit you to have that kind of name. So it cannot be a name which is sounding similar to other names. And if it is infringement of another trademark, then also it will not be allowed. Now, what are the guidelines for the Ministry of Finance? Is that, as I told you, is that PNQ as PQ industries will not be allowed. So we will have, even its phonetic resemblance also is there, it will not be allowed. Name cannot include a word cooperative or sahakari or similar words in regional language, because it cannot give an indication that it is a cooperative society or a cooperative bank or something like that. No, it cannot give any such indication. It is a business organization. It is a private business organization and not something which is a government end. So it cannot also contain the names like national, union, federal, republic, president, Rashtrapati. No. It cannot, unless it has got legitimate connection with the central government or state government, which it cannot happen. So it's a private organization. It cannot have those kind of words which will give a feeling that it is connected with the government or with the national body. No, you have to have a privately owned name. And of course, like how in a private limited company or a limited company, that limited word is important. Your LLP is again very important, and that LLP word is to be used irrespective of the name, whatever it is. Now, how the registration happens is, as per section 14 of the Act, registration shall be by its name become capable of suing and being sued. After being registration, you can that entity becomes like a body corporate, and it can be sued, or it can sue. Acquire, owning, and holding of, developing, and disposing of property with movable or removable property or tangible property, having a common seal, like how a company has, it can have a common seal, and doing and suffering such other acts as body corporates may lawfully do. So whatever a independent body can do, body corporate can do, as an independent person can do, a LLP can do it. It is distinct from its partners, which in case of a partnership firm, it is not that. Partnership firm is nothing but a co-ownership of partners. So there is a difference between this. Now, as I said, who can be partners in NLP? As per Section 5 of the Limited Part, any individual or body corporate can be partner. Now, here they have precluded any HUF or a partnership firm or any private trust to become partners in the LLP. So, as per Section 5, only two types of persons can become partners, like individuals. Of course, individuals are natural persons, so can be. Body corporate includes LLP. So, the LLP can become partner in another LLP. You can have a private limited company or a limited company becoming partner in an LLP, no harm. It can become. It has now, there are again certain other conditions which has to be satisfied because before a person can be admitted as a partner. If it's an individual, he has to be found to be of unsound mind by a court or competent, it cannot become a partner. He has to be of sound mind. He is undischarged insolvent. That means he is insolvent, he is not solvent. Then in that situation also he cannot become partner because his financial situation is not. I mean, he has not been in good financial economics. So he has not handled his financials very well. Because of that, he cannot become partner here. He is applied to be adjudicated as an insolvent in his application is pending. So even if he has not been declared insolvent, but he is applied for adjudication, then also he cannot become partner. HUF or its karta cannot become partner. I told you, partnership firm or maybe a private trust or an HUF or some any other unincorporated body cannot, AOP cannot become partner in a LLP. Now, how do you really apply for incorporation? There are two options available. First is that you first apply for a name availability in LLP run. Once you get the name, then you fill up the form Philip, and the name is valid only for 3 months. So if you have to fill up the form Philip within that period of 3 months and avail this particular name, and then Philip is the form for incorporation. Or another option is forget about his name approval, directly go for the incorporation application, that is Philip, and that Philip will be a composite document which will apply for name as well as PAN-10 and the entire incorporation. Here the only problem is, suppose in case if name is not available, then the entire process of Philip form has to be done again, because you will have to keep on till the time you don't get the approval, you will have to keep on filing it. Because in first case, once you get a name approval, then it is only filing of the form Philip, and that's the end of it. Whereas here, those forms might have to be refiled. So PAN-10 will be automatically generated. Then you will get an LLP identification number. That is an LLP IN, like how we have got a SIN number for a company, corporate identification number, company identification number. Here you will have an LLP IN, which will be the identification number of the LLP, which has to be quoted on all the stationery and any communication, so that your number is known to the person whom we are dealing with. Now, what are we supposed to, in incorporation document, what are we required to file is an address proof, because there is a registered office. So you have to give the address proof of the registered office. You have to give suppose if it is not your own property, you have to give the NOC from the owner, because you are using somebody else's premises. Why? Now, this is again why. Why it is required? Because earlier, government has found that people have set up bogus companies, bogus LLPs on a bogus addresses. And afterwards, then there are some claims or something has happened, some demands are there from the government or from some agencies. Then when they go to that particular address, they find that there is no such company existing. And it was all submitted to the government to some bogus addresses. And that is why they want an NOC from the owner saying that, yes, I am allowing this particular LLP or to be formed at my company. So tomorrow, if at all, if there is anything, that owner will have to give the reference of where to find that particular LLP, because if he must be having some connection, maybe some LLP, I mean some leave and license agreement or something which binds that person to that particular owner, and then only he will give an NOC. So there is some connection. Utility bill of that premises. The rent agreement is very important. Without a rent agreement, they generally now don't register. Now, in fact, in the GST also, it is very important. Without the earlier, they were registering the you can obtain a GST number without a rent agreement if you are on a tenanted premises. But now, a registered rent agreement is mandatory. So similarly, here also, rent agreement is important. LLP agreement is to be filed in form number 3 after incorporation within 30 days. After the incorporation, after you get the certificate, the LLC in case of a private limited company, you have to file the memorandum articles and everything together. But here, after the incorporation of the LLP, if you get 30 days time to file the agreement between the partners as to what are the terms you have agreed between the partners, it's duly signed and stamped and with the ROC. So that agreement becomes a public document, and what are the terms which has been agreed between the partners are reflected in this particular agreement. I will go into this agreement little more in detail. Now, as we have seen in the MOA, memorandum articles of a company, now generally there's a table A or there are standard clauses relating to the MOA. What articles? The article basically deals with the how the company is going to operate, how the board meetings are going to be held, how the AGMs are going to be held. All this is noted down in the articles of association, how the shares are going to be transferred, how the shares will be allotted. All that is there in the articles of association. In case of a LLP agreement, there are, of course, standard clauses. I will come to that. And those clauses, apart from that, the partners per se can decide any terms and conditions, any aspects which they want to incorporate in this agreement, which they want the other partners to be following that or to be bound by. It could be in account of goodwill. It could how the goodwill will be calculated, how the partners will retire, how partners' share will be worked out, how the partners, money on the retirement will be paid, or how the partners will deal with each other, who will be responsible for what. And I will give you one very interesting case about this, how the agreements are structured. Now, generally, when a partnership is entered between two parties, there is the possibility that one partner may be contributing something in terms of the stock in trade or the land for the project, and the other partner might be having the skills and ability to develop that project. So we have had one instance where there was a partner who had contributed land, and another partner was supposed to not bring in any capital, but he was supposed to do the work of the development, and the whatever profits they were supposed to share. But now sharing was already commercially decided. How it was decided? Okay, whatever, suppose for example, 100 rupees is the sale value of that particular unit when they sell, 30 rupees will go towards the person who has brought in the land, minus the land cost will go to his as a share of profit. And as far as the person who is going to work on the development, who is taking responsibility for construction and development, will get 70 rupees minus whatever the cost of construction will be his profit. Now, generally, when you look at any normal agreement, there is a profit, then there is salaries, there is interest, and then there is a share of profit, 50-50, 25-75, whatever, they decide that. Now, how do you incorporate this kind of situation in a profit which is 25% or 30%? Generally, in a private limited company, you cannot do all this because it will be whatever profits. When it is declared as a dividend, it will be based on the ratio of the shareholding. Whatever is the ratio of the shareholding, the shareholders will get the profits. Whereas in this LLP agreement or in a partnership agreement or in an AOP agreement, you can structure how you want the profit to be distributed. You can decide, okay, out of the whatever sale proceeds, this much will get, the cost for the partner A, the cost of the land, whatever he has brought in the company, in the firm, will get deducted, and the balance will be his share of profit. Whatever that is be worked out, 30% of the sale proceeds minus his cost, whereas 70% minus the cost of the construction, because otherwise the cost of construction is to be shared by both the partners. But here we can say, okay, no, only this partner will share, or the losses only this partner will share and not the other partner. All that can be provided in this LLP agreement the way you want it. It is like a clay, it is like a flexible thing. You can decide what you want. And that once it is incorporated into the LLP document, that becomes your the sharing pattern, and you can prepare your financial statement based on that. And we have done that in the past, and it has been accepted by all the regulators. So there is no problem in that. Now, what are the particulars that has to go in that LLP agreement? Is of course the name, object clause, the capital. What is the capital? Now, this is a fixed capital. We will come to the contribution level later, and we will discuss as to what is the difference. how do you define contribution? Because that contribution is linked to so many things like audit and other things. So I will discuss that as to what is the meaning of this capital and contribution. Registered office, where the registered office of the company is the LLP is situated. They can also have an administrative office. That is another thing. Registered office is their key office, which is governing their entire, and all the books of accounts, all the registers, what is required, have to be at the registered office. That is compulsory. Partners ratio, as to what is the ratio I mentioned to you, that is flexible, that you can decide. You can have 25%, 75%, 50-50, whatever. And also you can have this kind of caveats. Operating clauses for LLP, I told you. Now here again, you can have a salary provisions, you can have interest provisions, and also, because for the purpose of income tax, this LLP is considered as a firm. Although it has got a body corporate, it is a separate entity, everything is fine. But as only for the purpose of income tax, whereas for the purpose of general purpose, it is a body corporate, it is a separate entity. But when it comes to income tax, it has been defined as a firm. And for the Companies Act, it has been defined as a body corporate. So that naturally, it has got a separate entity. But for when moment you travel to income tax, then it becomes all the condition, all the privileges available to a firm will be available to this LLP. So your salary to the partner, interest to the partner, section 40B, everything applies to this LLP. And again, the taxation, everything is identical to what is applicable to a partnership firm. On that LLP document, agreement, there is a stamp duty, like how we have a stamp duty on the memorandum articles and we file with the register of companies. Here also there is a stamp duty. Now, the stamp duty will depend on which state we are dealing with, and accordingly, they will have to pay the stamp duty. Now, what happens if partners fall below 2? As I told you earlier, in a case of a partnership firm, if there are 2 partners, one partner dies, the firm gets dissolved immediately. There is no question of continuity. So, and all that, whatever is there, assets are there, it becomes taxable in the capital gain. But in case of, if the partner falls below 2, in case of a LLP, it doesn't get dissolved immediately. You have got time for 6 months to appoint another partner and continue the business. So it gets a perpetual succession. Right to receive the profit as a transferable right. That means now there is one section 42 also under the LLP Act, which permits you can transfer your right of profit without transferring the right of capital. You are a partner, but you do not transfer your right as a partner. Only you can assign your right to receive the profits to somebody else. Now, this is something very, very unique, because under Income Tax Act, there is another provision saying that the right to the receive income should go parallel to the right of receiving that asset. The asset has to be transferred, then only the right to receive the income has to be transferred. Whereas in case of a LLP, there is a specific provision that yes, section 42, where you can transfer the right of receiving the profits to somebody else, assigned it to somebody else. He will receive the profit, but you are still the partner, and he doesn't get a partnership right. He does not come and interfere in the business, but he only has the right to receive the share of profit. So, but taxability, then there is section 56, gift and all that thing. Let's not get into it. It's an income tax issue. We are looking at purely LLP perspective. It is possible, but you have to look at the income tax angle also, because there could be a gift angle, there could be section 56 angle, there could be a taxation issue on that. Because whatever for example, the exemption which a partner enjoys under section 10 for the share of profit, that other person will not enjoy, because he is not getting a share of profit from the partnership firm, because he is not a partner. So section 10 requires that it should be from a partnership firm as a partner. Now, when you assign your profit to somebody else and he receives that share of profit, now for that partner, this thing will not be considered as a just one low battery indication. So this person who receives the money will not get tax exemption. Apart from that, there could be a gift issue also, which we have to look at section 56 and how to examine that. But otherwise, under the LLP Act, it is possible. Now, another very interesting aspect from the taxation perspective, which we'll deal with a little later in the last slide, but just want to slightly update you on that. Okay, so far, Section 56, when we have referred to Section 56, 56 deals with the transfer of assets of in terms of shares, any transfer of shares or transfer of properties. We have to look at the fair market value versus the actual consideration, and then if there is a difference, then there is a Section 56 applies. But so far, the transfer of LLP, suppose for example, I am partnered in an LLP and I want to now come out of LLP and somebody else is taking over my right. Suppose I am holding 25% in an LLP, right to contribute, right to have a capital and the profits. Selling my right to some third party, and I am coming out of this LLP. Maybe I am 25%, I am diluting to 10% and 15% somebody else is coming up and I'm getting some consideration for that. Taxability other part, that valuation part is still not applied to the valuation of that particular right, whether I'm selling at a price which is fair market value or not, that is not examined by 56. It is outside the purview of Section 56. Yes, capital gain definitely applies. We have to look at those capital gain sections 45 and apply it. Now here as a partner, there are various types of partners we will be dealing with. There is something also. One is something called registered partner and beneficial partner. I will park this as of now because there is a separate slides on this for registered partner and beneficial partner, giving in detail as to what it means, how it impacts, and what are we going to deal with it. So that we will come to a little later. Now, partner. See, let us understand this concept with an analogy of a company. We all know in a company there are two types of people. One is a shareholder and one is a board of directors. Now, the shareholders are akin to these partners. So, partners are the owners of this LLP. They are the people who are like akin to shareholders. Okay. Now, this designated partners, which is amongst these shareholders, amongst these partners, two people are designated as a designated partners. They are like the directors which are in the board of directors of a company. Now, we all know that in a case of a board of directors, you can have a directors who are not a shareholder. In LLP, that situation is not there. Designated partners have to be partners. But yes, they can represent also a partner. For example, if there's a body corporate, and the body corporate cannot become a designated partner, because for designated partner, the condition is it has to be individual. Now, body corporate, there, suppose, for example, in LLP, there are only two body corporates. So from where will you get individual designated partners? So these two body corporates will nominate one each person as a designated partner. So that person who is now representing as a designated partner on behalf of the body corporate, he is not himself in his individual capacity a partner, but he is a designated partner as far as the LLP is concerned. Now, in normal situation, when there are individual partners, out of, let's say there are 4 partners, 2 can be designated as a designated partner. All 4 can also be designated as a designated partner. There is no upper ceiling. Minimum is 2. But we cannot have 1 designated partner. You need minimum 2 designated partners. You can have more numbers. Now, these designated partners have certain responsibilities. I will come to it a little later as to what are the responsibilities, what are the liabilities. So, a designated partner is slightly different at having an upper pedestal compared to a partner. Partner is a passive person who is a part of the organization, sharing profits, fine. But a designated partner, now please do not confuse this partner, designated partner with a working partner, which is defined under the Income Tax Act. This LLP document also, apart from this designated partners, can designate working partners, can define working partners. Now, there could be possibility there are non-designated partners can be a working partner also, but he is contributing to the business, but he is not a designated partner. It is possible. So you can have a partner simpliciter who is not at all active in the business. He is just in a passive, silent sleeping partner. There could be a designated partner who is responsible for certain provisions of the LLP Act, and there is a third category who is the working partner. Now, working partner could be designated partner also, it could be other partner also. So anybody can be appointed as a working partner as defined under the LLP agreement. Who are the designated partners? Who are the working partners? And who are not so defined are simple partners. Simple. So if there are 4 partners, 2 can be designated partners, 3 can be working partners, and 1 can be simple in the sleeping partner. So it is possible. Now, the difference between the partner and designated partner, I told you, is been defined under the LLP document. So in accordance with the LLP document, whoever is the considered as a designated partner will be designated partner. And it is as per section 7 of the partner designated as such pursuant to section 7 of the LLP Act. Now, so at least as I said, it should be at least 2 designated partner, and there is one more condition that out of this 2, 1 should be a resident in India. That means there could be 1 designated partner who could be a non-resident Indian, but both the designated partners cannot be non-resident. Now the question is why? In India, compliances for the various factors are very important, and the government wants somebody local to be made responsible. Now, I will take you to a very old matter of Bhopal gas tragedy, where there was one foreign company. The MD was based in US, and when the tragedy happened, there was nobody here in India from the all the directors were non-resident, and there was nobody here in India who could be made responsible for this tragedy, and huge number of lives was lost because of that some negligence on the part of the company, and they could not file case against anybody because they were all outside India and they cannot bring them to India. And of course subsequently they were brought to India or something had happened, but it was a very difficult process. So they want somebody, after that they've learned a lesson, and then they said they want somebody local. And that's the reason they've made this provision that out of these 2 designated partners, 1 has to be local who has stayed in India for at least not less than 120 days in India. Earlier, this period was 180 days. Normally, we all know non-resident, resident status are 180 days. But for this purpose, it was amended recently in 2023. This particular provision was amended to make it 120 days as against 180 days. So you need 1 resident LLP partner, designated partner in India, whom the government can catch hold of in case of there is any non-compliance or any violation of the LLP Act or any other act. For example, if there is an environmental breach or if there is a provident fund, this income tax, so there is somebody in India who can be prosecuted or they can catch. Now, what is the liability of a designated partner? As I said, there is the unlimited liability, but here there is certain unlimited aspect to that, because if there is a person who is responsible for managing. Now, what is the responsibility of a designated partner? Designated partner does not mean whole-time director or whole-time partner. No, working partners are defined under the agreement. So they are working partners, they are whole-time partners, they will draw salaries also. Now, a designated partner is a person who is responsible for compliances under the LLP Act. Means tomorrow, if there is any form which is not filed, the penalty will go to this LLP as well as this designated partner, and he will be responsible as to why he has not filed the form. So the other partners who are not designated partners may not be levied penalty, but the designated partner definitely will be levied a penalty. He'll be responsible for doing all the acts, matters, and things as required to be done under the liability partnership in respect of compliance with the provision of this act. So they are compliance managers, and they are required to do all the filing of documents on behalf of the LLP. To all penalties imposed on the LLP partnership for any contravention of these provisions. Of course, the LLP also is been slashed with a penalty, and also this designated partners also will be levied personally penalty for non-compliance because they were responsible for complying with those provisions. So what is the extent of this thing? That yes, they will not be personally liable if they have not done any wrongful act or omission. Suppose, for example, there are 2 designated partners, and if one designated partner is in a position to prove that he is not done anything wrong, even the other partners, they can be held responsible if they are personally liable, if they have done some wrongful act or omission. So if they have done something wrongful act or omission, yes, they will be personally liable. Any fraud done by even a non-designated partner will also be responsible. And one more thing is that one partner will not be responsible for the wrongful act of the other partner. If the one partner has done something fraud, then the other partners will not be liable for the fraud of the partner X, because Mr. X or whoever is the person who committed the fraud will be responsible and not the partner who has not committed the fraud. You have to, of course, prove it, then only it will be liable. Now, extent of liability of LLP is not bound by anything done by a partner in dealing with a person. For example, in case of a partnership firm, a partner binds the firm because partner is an agent of the firm, and he does whatever act he does, it is doing on behalf of the firm, and the person who is dealing with that partner is thinking that he has got a full authority, and whatever he is doing is the firm is doing it. So tomorrow, if he makes any commitment on behalf of the firm, then that firm is responsible. Here, he is not bound by any partner dealing with another person. So partner has no authority for the LLP in doing a particular, you need a resolution. Like how in the company you have a resolution, you need a resolution from the LLP, and then only that LLP can be bound. If he has got no authority, he will not be in a position to do that act. So it is even it can contract also, you need a resolution from an LLP. A partnership firm, generally you require all the partners' consent before they do any contract or agreement. Whereas in this case, any one designated partner can sign on behalf of the LLP, provided of course there is a resolution and the resolution authorizes him to do that. And if there is any liability of the LLP, it will be met out of the properties of the LLP first, and it will not travel to the individual person's assets unless they are themselves committed a fraud or guilt. Then only it will travel to the individual. Now this is very interesting. Contributions and audit. We all know that as far as the LLP is concerned, there is no share capital, but there is a contribution in terms of the capital in the LLP. Now, how much is the contribution? What do you call? See, there is a lot of controversy as to what is the contribution amount. There is some limits also for the audit. Like, for example, contribution exceeding 25 lakh requires an audit, compulsory statutory audit for that particular LLP. Tax, I'm not talking about tax audit. I'm talking about the audit under the LLP. For that, if the contribution exceeds 25 lakhs or turnover exceeds 40 lakhs, then audit is applicable under the LLP Act. Now here, what is contribution? This is the most controversial point of debate. Section 33 says that contribution means what is the contribution defined under the agreement, what a partner is required to contribute under the agreement. Now, generally the agreement provides that the fixed capital will be 1 lakh, 50,000 or whatever, 10 lakhs, that all the partners at the initial level or under a modified need have agreed, yes, this will be our capital of the LLP. And once they have decided, that becomes the capital of the LLP. And if that contribution is more than 25 or 25, it exceeds 25 lakh rupees, then the audit issue will come up. Of course, there is another criteria of turnover also. So if the turnover exceeds 40 lakh rupees, then you don't have to look at 25, because any one condition is satisfied, then audit is applicable. So if your turnover is below 40 lakhs, and then your contribution, you have to look whether your fixed capital, which is mentioned in your agreement, is about 25 lakhs or no. Now here, it is quite possible that sometimes even the LLP document also says sometimes that the partners may contribute as much as possible as may mutually decided, and that becomes the current capital. And it's like a loan to the LLP. The partners can give loan to the LLP, or it can give as a current account. So whether the current account is also to be reckoned for the purpose of 25 lakhs, in my personal opinion, no. We always look at what is section 33 of the Act, and the section 33 says that what is the contribution capital mentioned in the agreement, and that becomes a contribution. And if that contribution exceeds 25 lakhs, then yes, your audit is applicable. The books have, now suppose the partner can contribute in kind also. It is not necessary that he should give a check only. He can bring in property, he can bring in land, he can bring in stocks or whatever. He can bring in assets, which is a contribution, and that assets will be debited to the books of accounts and credited to his capital account or current account, whichever. I mean, depends on what is the contribution he has brought in. And that is allowed. Now, how do you value? Because there is no value to it. So you have to give the value in the books. Now, the value has to be done by a valuation report of a chartered accountant or a cost accountant or from an approved panel of a central government for getting the value, and that value will be recorded in the books of accounts. Now, even the books of accounts are to be retained for 8 years. Similar provisions there in the Companies Act also. Of course, income tax now there is a slight change, but we are not getting into it. As far as the LLP Act is concerned, it is requiring that the books should be retained for 8 years. The MCA can go in for inspection of the books of accounts, and that time you have to produce those books of accounts for 8 years. Now, format of the FS is basically standard FS, which our ASB, our auditing and accounting standards, have already prescribed a particular format. And also there is a guidance note on this particular aspect about the accounting standards and all that, what is applicable, and that we have to comply. There is a similar format which we are using it for companies, except the wordings are slightly changed. Now, recently they have introduced, this was not there earlier, they have recently introduced a new concept in LLP called small limited liability partnership. Now, like how we have a small company concept under the in the Companies Act, we have got a similar concept of small limited liability. Although we initially thought that LLPs are small businesses, but now they are growing. Even the LLPs of doing businesses worth thousands of crore, hundreds of crore. There is no limit. There is no ceiling that it has to be converted to company. There is no such thing. So LLPs are also doing a huge business. So it is not no longer they are all small entities or small businesses. Even I mean I will share with you that in my so many years of experience, earlier we were our clients were requesting for companies formation. Even the small entities, small partnership, I mean small family-owned businesses, they wanted a private limited company. Now, since last several years, we are getting more requests for LLP formation rather than private limited company because of the complexities of the kind of compliances like Section 73 or 185, 186. There are so many compliances. Again, this the dim dividend and dividend taxation and all that. For that, they prefer this LLP formation. So LLPs are now the most popular mode of business module, and most of the entities are in an LLP format. Even now, the chartered accountant firms have started forming LLP because it is allowed to audit as a LLP. Earlier, only partnership firms or proprietorship firms were only allowed. Companies are definitely not allowed because it's but here they have allowed LLP as or an institute has allowed LLP to sign the balance sheet. So there are so many LLPs I have seen who have in terms of chartered accountant firms. Now they have come out with this small limited liability partnership. The reason is they want to still give some benefit to those smaller entities, that they don't have to go for a lot of compliances, number one, and also the kind of penalties which are there. There is some subsidy in that. I will come to that as to what are the major things. The one is that as far as the audit is concerned, they have a contribution. They have still maintained 25 lakhs and 40 lakhs per limit, but there is a buffer. It says it can go up to 5 crores, and in case of turnover up to 50 crore is the authority which the government has got to increase this thing of a small liability company. As of now, it is 25 lakhs, or such amount not exceeding 5 crores will maybe notified later, as may be prescribed. It will be notified later, like in case of small companies under the Companies Act, they have gone up to a very high level. But now, as far as the small LLP is concerned, it is presently 25 and 40, which is similar to what is there in the Act itself for the purpose of audit. So there is no major change here, but it can subsequently be changed. Then there is another thing is that as far as the the other benefit is as far as the lesser fees, additional fees compared to normal other than the small LLPs. So there also there is a benefit. Now, even in this case of a any ROC fees or any form filing or registering of recording of notice for appointment, intimation, all the fees have been reduced. Not only the additional fees or penalties, but even the normal filing fees also have been reduced in terms of small. There is a full chart showing what are the differences later on when we deal with the penalties and the fees. We will discuss that at that stage. Now, what are the compliances which one has to do for the LLP? It's a basic compliances. Every year, there is only 2 annual compliances which one in any LLP has to do it. One is the Form 8 of the financial statement and solvency, which it's similar to our balance sheet filing, statement of filing for the companies, which we do it in October after the 6 months and when the AGM is over, and within 30 days we are supposed to file the balance sheet and P&L account statement of financial statements with the ROC. In the case of a company, a similar provision is there in the LLP Form 8, which says 30 days from the 6 months ending. Because there is no question of an AGM in case of LLP, but they have prescribed almost about similar timelines for filing this Form 8. And then there is a Form 11, which is an annual report. Basically, annual report is the only details about the partners, any changes are in the partners or anything. That has to be filed with the ROC in form number 11 by 31st of May. So 31st May is the due date for filing form number 11. And if that annual return has to be certified by a CS, if the turnover is greater than or equal to 5 crore or contribution is greater than or equal to 50 lakhs, then you need to get a CS to certify this particular form. Form 4 is required to be filed for changes in the partners. If there are any changes in the partners during the year, then you have to file that form number 4. In similar thing is in the company's case, if there are changes in the directors, then you are supposed to file a form with the ROC. Now I'm coming to a very interesting aspect in case of LLP, which was not there earlier. Okay, this has been introduced from 2023 onwards, somewhere on August or November 2023, an amendment has happened, and that amendment has brought out this particular aspect. And after that, there is another very interesting chapter on the SBO, significant beneficial ownership. But one thing, let me clarify. Beneficial interest disclosure and significant beneficial ownership are two different things. Please do not mix up. They are two poles apart. They are totally different. They are not to be confused, not to be discussed. I will explain. People get confused getting the beneficial interest and SBO are same. They are not same. I will explain you in a very simple language, simple way, a concept, what is beneficial interest, what is SBO, because both have to be complied with as far as the LLPs are concerned. And now, okay, before we go into this, let me start with the first thing that initially when we started this discussion on the LLP, I mentioned that only individual or body corporate can become partner in an LLP. You cannot have a trust, you cannot have a partnership firm or an AOP or an HUF cannot become a direct partner in an LLP. So that was a prohibition under Section 5 of the LLP Act. So very clear-cut prohibition. Only two people were permitted to become partners. Now, there was a circular earlier, circular number 35 by 2014 of the MCA. Somewhere in 2014, they issued a circular. Before all these provisions have come in, there was a circular. Till such time, everybody was of the impression that you cannot have a partnership, LLP with any other than individual and a body corporate. Body corporate will include LLP. That means you can have an LLP as a partner, but you cannot have a partnership firm or a HUF as a partner. Now, there was a circular from the MCA in 2014, which clarified. Somebody must have asked a question, and based on that question, they have clarified. They have only answered what was the question. So they have not given a generic reply as to what is the permissible partners who can become partners in LLP. But they only answered what was a specific question, whether there are many private trusts who are managing those, alternate funds or mutual funds or, REITs, REITs. REIT is the real estate investment trust. they are basically controlled by SEBI, and SEBI has got those registered with the SEBI, and they are controlled by SEBI. And all this trust will have a body corporate as a trustee. We cannot have individual as a trustee because that is a requirement of SEBI. So they are all body corporates which are managing this particular trust. Now, MCA clarified that since the trustees are body corporates and body corporates can become, partners in an LLP. So this trust through the body corporate, the trustee can become partner in the LLP, but they will not be considered as a partner per se in their individual capacity as a trust, but it is a trustee who will become the partner, and he will be representing the trust and not the directly in the name of the partners. You will not have the trust, but it will be the trustee, and you will not say it's a trustee of so and so trust. It will be straight Mr. XYZ or that company, whoever is that body corporate. It will be his name, the company's name as a partner. So this was permitted, rather clarified, not permitted. I would say clarified under that circular, and that circular only answered what was our question asked. So there was no question on the other private trust. So there was no answer on that. Now, if you apply the same analogy, if a body corporate being a trustee can become a partner here because body corporates are permitted to become partners. Similarly, in a private trust where the trustees are individuals, whether they can become partner in an LLP in an individual name, but representing this particular private trust. Now here, at that juncture in 2000, maybe 16, 17, or when this particular circular was issued, we had sought some, we wanted to, one of our client wanted to introduce one private trust in the LLP. So we had sought an opinion of very senior company secretary who is practicing in this particular aspect, and his opinions are very valued. So we had sought his opinion, and he had advised us that, look, this circular says body corporate allowed because of this particular thing. It doesn't talk about individual trustees becoming the partners on behalf of any other entities. So he said, no, I do not agree. I mean, I do not opine that any other person can become partners in this particular thing. And again, he at that time said that there is no reporting, for example, for a beneficial interest, because if you look at the Companies Act, there was initially one section under the Companies Act 1956, there was section 187 where you had to file certain form for beneficial interest, and subsequently under Companies Act 2013 there was section 89 which requires you to file certain forms when there is a beneficial interest. Like for example, if you have a wholly owned subsidiary, you need one nominee member, and that nominee member or nominee shareholder is not holding share on his behalf. He is holding shares on the behalf of that company, because the company is 100% shareholder of that particular company, but it cannot hold in its own name 100% because you need two minimum members. So one person becomes a nominee member for that company, and then they file 187 just to say that, yes, I am not holding in my capacity, but I am holding it in the capacity of the company. So this kind of forms and provisions were already there under the Companies Act. Similar provisions were never there under the LLP Act. So on that basis, he opined that since there is no such provision of a declaration of a beneficial interest, we believe that this particular provision is not applicable. Then later on in 2023, this particular provisions were introduced under the LLP Act. By virtue of this, disclosures were required to be made in case of any such beneficial interest being held by any person. So now, by reading the thing in the proper perspective, one can feel that when there is a provision where a person who is a in his individual, who is with a partner in his individual name, but is not having a beneficial interest, has to file certain forms. This indicated that there are other forms of entities who can become partner not in their individual name, but through their trustees or through their partners or karta or something, and they can still become partners in this LLP and enjoy the benefits of the LLP. So it is by way of this. There is no specific any mention in the LLP Act nor in the rules as to it is permissible, but this is a conjecture drawn based on whatever we have read through this. Now, Now here what they are trying to explain in this beneficial interest is they have defined this registered partner and a beneficial partner. I told you earlier, we have started with a registered partner, and I told you we will discuss in detail when we go to that particular aspect. So a registered partner is a person who is not holding beneficial interest in his own name, but he's only a is the you see now they also introduced one new concept of register of partners in the same rules amendment, that there should be a register of partners mentioned, and all this thing should be indicated who are the partners of this particular LLP, and what is the designation, what is the capacity, whether they are registered partner, ordinary partner, designated partner, whatever, they have to be mentioned under that register of partners, and it is mandatory to maintain that register of partners. So the registered partner was a new concept which came into the play from this amendment. Now so if Mr. X, who is an RP, is a partner in his name, but beneficial interest is owned by a private trust or a firm, that is called a beneficial partner. Then that means the firm is a beneficial partner, the trust is a beneficial partner, but the Mr. X is a registered partner. So now the new concept has come into play, registered partner and a beneficial partner. Now what are the formalities to be done? The registered partner will have to intimate the LLP that in form 4B that yes, look, I am the registered partner. I am the in my name the I am holding the partnership, but my beneficial interest is somebody else. Mr. The trust is the beneficial interest. In this form, he will give this particular declaration. He will give the reasons why he is not registering the trust in his name, and this it has to be submitted within 30 days of acquiring this particular interest. And similarly, the beneficial partner will also have to give a notice to the LLP saying that I am a beneficial partner and this man is a registered partner only, and he is on my behalf. So that declaration comes to the LLP. Now LLP either he gets a notice from the registered partner or notice from the beneficial partner, 4B or 4C. They will have to file one 4B with the ROC and saying that yes, these are the beneficial partners and these are the registered partners which we have got. So it is a public document which is available for the public to see who are the beneficial partners and who are the registered partners. So Mr. X may be the registered partner, but there is somebody else who is behind it who has got a beneficial ownership. That is already available on the webs on the MCA site. So it is all public disclosure. So this is the requirement of the thing. Now let's look at the another aspect, significant beneficial owner. We have got a huge amount of transit to be done for various aspects. So we might need to move a little fast because we are already at 4:15 and we've got about 45 minutes to go. So significant beneficial ownership. Now this is something again a new introduction under the LLP Act. We all know Section 90. Section 89 talked about beneficial interest under the Companies Act. Section 90 talked about this SBO under the Companies Act. A similar this Section 90 has now been made applicable to the LLP by virtue of Section 67. 67 says that there are certain sections in the Companies Act which now will become applicable to the LLP. And what they have done is only thing they have changed the names. For example, if their director is referred, it will be considered as a designated partner. If the partner is referred, a shareholder is referred, it will be partner. So this is how they have changed the wordings in that particular Section 90, and accordingly, it is made applicable to even LLP. Now, what is significant beneficial ownership? Now, this is something different from what we discussed about the beneficial interest. Beneficial interest is something where a person has become partner in his individual name and is representing somebody else. So there is a person behind him who is going to enjoy the benefits. He is only the representative of that person in the LLP. But in case of SBO, it is totally different. It is nothing to do with this situation. Here you have, let's say, for example, an LLP has got a company as a partner. Now, when you have a company as a partner, now this company may have shareholders. Now, shareholders could be again company in that company, and it can go on. The government wants to know who is the ultimate owner of this particular company, who is the partner in this LLP. That means the LLP has got certain partner who is a corporate entity. They want to know who is the ultimate individual behind this particular. They are lifting the veil and says कि भाई ये पर्दे के पीछे कौन है? Who is the actual person behind it? who is trying to hide behind all these facets of the corporate veil and trying to hide his identity, because all these documents are public documents. That means if the partners' details are all available on the MCA website, the company's shareholders' details are all available on the company's website. So now, suppose if today, if I am looking at that LLP, ex-LLP, and it's got 4 partners who are all corporate, I may not know who is the real owner. And I'm dealing with an LLP, I don't know who is the person behind it, whether it's some antisocial element is there or any terrorist there or anybody, we don't know. So the government now wants to know who is the real owner of this particular LLP. And for that, this particular rules have been framed. And the similar concept is there in the Companies Act. They want to know, go behind and find out who is the actual person behind this particular company. So here also they have casted a duty on that on the LLP, that you have to now find out who is their ultimate owner, actual owner. So now they have defined various things. Now here it says they have kept a margin of 10%. That is a threshold limit of 10%. They feel that anybody who is having a 10% or more interest will have certain interest in this particular LLP. Below 10%, they are really not significant. So they are considering significant amount of investment as 10%. So anybody who 10% or more needs to be reported on the website, so that they know that ultimately on this LLP, the person behind this particular LLP is Mr. XYZ. That they want to know individual person, a natural person. So you drill down to the last level and find out who is ultimately the individual behind this particular LLP. So you have who is holding together indirectly with any direct holding. Now, for example, if an LLP has got a individual person, suppose holding 20%, that doesn't be reported because it is already there on the website, or he is an individual partner, so you don't have to again do any declaration. But if there is a company and then the company has got a shareholder, then yes, you have to give a declaration. So if they are indirectly to direct holdings, at least 10% in respect of the rights in respect of management or policy decision. It is not only in the shareholding, but they right they may not have the shareholding, but they have a right in the management policies. They might have by way of an agreement that I can appoint directors or I can have policy decisions. So then also that particular thing will be covered. It's not necessarily a 10% of shareholding. 10% participation in total distributable profit also will be covered. And significant influence also is important. If he is influencing significantly, then also that will be covered. So if it is, of course, there are exceptions. If it is held by central government and all, we are not interested because central government has got its own machinery and all that. So we are not interested in knowing who are the people behind central government. It is the government. So we are it is a futile. Even the organized or any organizations controlled by the state government also is not covered. And investment vehicles registered with the SEBI, that also, because SEBI has got its own machinery to control it, so they don't want it because there might be so many individuals in this REIT or any mutual funds, so they don't want to get into it because it is very difficult and a cumbersome process to get this kind of declarations. So now again here there is a one layered. I will give an example of this particular how to calculate the structure. Suppose if an individual holds 60%, let's say there is a bottom line in the last round, there is an individual who is holding 60% of, let's say, one company called X Limited. Okay, he's holding 60% shares. Now this X Limited is holding, let's say, let's say 50% of the shares in the other company, and then there is another this LLP. I mean, this that entity is holding 30% in the LLP. Then if you do a look through calculation, it will come to 9%. What I mean by 9% is when the company, ultimate company, is holding 30% in an LLP, effectively whatever I am holding 60% and 50% or whatever, ultimately my control from the bottom to the top will be only 9%. So then I am below 10%, so I should not be reporting this particular in the SBO rules. But no, they have plugged this loophole because in this situation, then this reporting will not come up. So what they say is that you don't look into this look through when there is a control. Now, see, if you see 60%, then there is a control. You are controlling that company, ultimate holding company, you are controlling by 60%. So whether you hold 60% or you hold 100%, it is the same, because you have the powers to pass resolution. You have the powers to you are in control of the company. You are the owner of that company, because by virtue of holding more than 50% of the shares. So because of that, you are the 100% owner. So you don't consider this as a look through, but you look at 30% is the ultimately in the LLP. So then you more than 10%, because ultimately you are controlling 30% of the LLP. So it is a very logical thing. You don't go by the percentages, but you are go by the control. You are controlling that company X, that X company is controlling company Y, and that Y has got only 30%, but 30% is more than 10%. So actually you are actually controlling 30% of the LLP. And because of that, you are a SBO, and you have to disclose your interest in the company. So this is how the 10% threshold has to be worked out. And what are the things to be done? If in this situation you have to file band 1, to make a declaration in band 1, that means the person who is holding this 10% will have to give a band 1 to the LLP, saying that, look, this is the beneficial interest of, I'm having beneficial interest in this LLP. And the moment that is filed, this LLP will have to file band 2, LLP band 2. The wording is LLP band 2, LLP band 1. Band 1 is in the Companies Act, but here it is LLP band 1 and LLP band 2 to the MCA side. And then that becomes a public document. Because of that, people will know who is the ultimate owner of this particular LLP. And it's only a matter of disclosure. That is the reason it is required. Shifting of registered office is a very simple process. Of course, if it is from one state to another, you have to take a consent from the secured creditors, consent of all the partners. Public notice is required to be given in a newspaper. And after 21 days, you have to file the form with the ROC, that's form number 15. And if it is within the state, you have to follow the same process, except consent from the secured creditor is not applicable. Now, compounding of offenses. Here, as I understand, we have seen compounding of offenses in income tax, compounding of offenses in the Companies Act. What we understand in the income tax, particularly the TDS, is when there is a prosecution involved, that offenses can be compounded by paying some fine or fee, and compounding fee, and then prosecution is avoided, but you have to pay a financial cost. Now here, the compounding can also be done not only for prosecution, but also for fines. Because if the fine is huge, because in LLP, sometimes you cannot pay that kind of fines. So you can ask for compounding, and then they come out with a compounding fee, which might be slightly lower than what you would have paid otherwise in the fine. But if there are any offenses, then they are condoned, and then you pay a compounding fee. Of course, that within 3 years, if you can only do it once, but if within 3 years, if you do it twice, then you don't get that benefit of compounding. After 3 years, if it happens again, then it is considered again as the first offense and not the second offense. We will quickly skip this and go to the next one, is the conversion process of the LLP. Now, earlier, conversion process was already contained under the LLP Act, but respective income tax provisions were not very clearly available for exemptions. And because of that, these conversions were not taking place. And by virtue of that, the companies were not getting converted into LLP. We know we have dealt with those matters earlier. When these provisions were there earlier also, to convert an provision, enabling provision to convert a company into an LLP or a partnership firm into an LLP, it was possible. Similarly, from LLP to the company and other way around, it is all possible. Now, from the company to LLP, why would somebody want to do it? Because if they have earlier been settled with a company structure, and now they want to take the advantage of this LLP's beneficial tax structure or the compliances, and they want to come out with that, and they want to bring it to company. Yes, now these provisions can be used. They can only convert into an LLP. The firm can be converted, a private limited company can be converted, an unlisted public company can be converted. A listed public, naturally, because listing is a lot of formalities which has been done on the public forum, you cannot convert that into a LLP. Firm can apply to convert to LLP only if the partners into which the firm is converted comprise of all the partners and no one else. Now, another thing very important is that while conversion, we have to ensure that there is no charge or anything existing. We have to satisfy the charge, and then only we can apply for conversion. You have to file. Another very important thing is that conversion also is called vesting. When there is a conversion, there is a vesting of all the assets, is a going concern. So there is no transfer as such, and there is an income tax angle which we will deal with it at the last, as I told you, that Puri, which we will discuss as to what are the implications on the tax angle from the capital gain. It doesn't amount to a transfer because it is a vesting of the assets and liabilities in the hands of the LLP from the company. The registrar you can apply in form number 17 for conversion, and then it can be within 15 days. 15 days, the registrar will issue a certificate of conversion in form number 19. Now, what are the preconditions that there is no security interest? I told you there should not be any charge existing in the company. The charge has to be first satisfied, and you convert to LLP, and LLP then again can create a charge. But first you have to satisfy this charge. With the charge, you cannot convert that into an LLP. That is a precondition. Now, all the partners who convert should comprise of all the shareholders of the company. So there cannot be anybody else coming as a partner in the converted LLP. The same shareholders will become the partners here. The same name should also continue. Only the private limited and LLP will be changed. You cannot then afterwards you can always change it. But initially, when you get the conversion, the same name will be given. Now, what happens with the effect of that is that there should be an LLP by the name specified in the certificate. All tangible assets and everything, whatever whatever the contracts, whatever their litigation, everything will get transferred to this LLP. It will be vested in the LLP. So it is as a going concern. Whatever the company was doing, the same thing will come into the LLP. So it is not a transfer, it is a vesting. So whatever could have been done under a company, now it can be done under the LLP. And the company shall be stand to be dissolved and removed from the records from the Companies Act. All proceedings I told you will get transferred, and all conviction, rulings, judgments of the court, tribunal, everything will shift to the LLP. You don't have to do any further act to do that. So it is all automatic. So now another very important thing, for 12 months from the date of the conversion, you have to ensure that on all the publications, you have to mention that it is a converted from a private limited company. That you have to mention for nearly 12 months after the date of conversion, so that the person knows that this is a converted from a private limited company and not a new LLP which is formed. Now, a foreign limited liability partnership is also permissible. Now, what is a foreign limited liability? Any LLP formed outside India, and now they set up a place of business in India under the provisions of FEMA. FEMA permits. There are certain procedures to be followed. Once that procedure under the FEMA has been followed, and that particular LLP has set up a business, a branch set up a place of business in India, that branch or place of business can be registered under the ROC here as a foreign LLP. And within 30 days from this place of in the place of business, you will have to file one form number 27 with the registrar, and you will get a certificate for foreign LLP. And foreign LLP can do whatever allowed, permissible under the FEMA, whatever business is allowed, it can do the business, and it has to file or various forms, Form 8 and 11, whatever is applicable to a local LLP, they will have to file with the MCA or whatever is applicable. So they have to disclose all the information in form number 27 about the foreign LLP. And once that LLP's business is over, then they will have to immediately close this particular LLP, and they have to write to the ROC to delete this particular LLP, which is possible. Now, all the documents which might be in the foreign language will have to be notarized, will have to be apostilled over there, and then given, because it may be in a different language, maybe in a local language, which has to be translated and apostilled and then submitted to the ROC, because only English language is acceptable here. So you have to get it translated. So this is what I have discussed. It is compromise or arrangement of an LLP. Now, we all know in Companies Act that there are mergers, demergers, acquisitions, and compromises are permissible. Similar provisions are there under the LLP Act. You can do a mergers between two LLP. So far, LLP and company cannot be merged. That is a specific prohibition. You cannot do that. Between the two LLPs, yes, merger is possible, a demerger is possible, all compromise and arrangement. Basically, when you talk about arrangement, it includes demerger. And arrangement also includes merger. Now, how do you do this merger? You have to go to the NCLT, which is same applicable in case of a company's mergers or demergers. You have to apply to NCLT. You have to follow the process of the entire NCLT process of getting the consents and filing those forms, getting the due diligence done, getting the audit done, valuation, all that thing is required. And once it is done, NCLT will issue an order for that compromise or arrangement and the demerger, and accordingly that will be implemented and given effect in the accounts. So it is the NCLT which deals with this situation. Now, the process is the same. You have to file an affidavit in form number 20 with a copy of the proposed compromise or arrangement and copy of the summons in form number 21. And within 14 days, we are supposed to file before the next hearing. They will fix up a place on time of hearing, the meeting. They will appoint. Suppose, if, for example, now I will tell you how it works. In case of partners, if the partners have if there is a compromise between the partners, for example, if there is a demerger or a merger of two LLPs, if the partners have given the 100% consent, then the meeting of the partners is dispensed with by the LLP. But if there is a compromise of the creditors, if there is a creditors compromise is required, then either the creditors have to give a consent or a NOC to dispense of the meeting, or their meeting will be convened by the NCLT. NCLT will conduct the meeting through its chairman. They will appoint a chairman, and the chairman will conduct this meeting, and the chairman will then report to the NCLT what is the outcome of this meeting. All that will be reported by the chairman of that, by chairman report to the NCLT, and based on whatever the discussion happens in the meeting, that will get forwarded. Suppose if the scheme is not agreed by the majority of the creditors, then that scheme cannot be workable. And if there are any objections from any creditors, those creditors have to be settled before the scheme can be. They have a right to raise an objection before the NCLT also. If I know my dues are not being paid, or I've got some contingent liability which has not been paid. Now, all that thing the NCLT will consider, and once they come to the conclusion that whatever are the dues to be paid or not to be paid, then based on that, the decision will be taken by the NCLT, which will be final. Of course, there is always an appellate bodies are there. It can go to High Court also. So that process goes on. We will quickly move to the next point because we are already running a little short of time. This is a very vast topic, and I'm trying to cover as much as possible. Rehabilitation or revival of an LLP. Now, many times the sick LLP is there. They've got a debt which cannot be paid off. Early in the Companies Act, there was a SICA. There was a Sick Industrial Companies Act, where BIFR was the mediating authority, where they could bring in all the parties together and resolve a scheme of rehabilitation and let the company survive, or it can go and get rehabilitated. Similar provisions are there here also. Now that SICA has gone out, and I think it is now with the NCLT and all. So similar provisions are there under the LLP Act for the rehabilitation or revival of an LLP which has got debt which is more than its capacity to pay. So then the NCLT can ask their creditors to do some compromise or arrangement, or the management will have to come out with a scheme as to how they are going to pay off these creditors over a period of time. So the creditors also will get their dues out, and the company can also continue its business. So all this is a part of the scheme which is formulated, and that scheme is implemented under the supervision of the NCLT. So what are the documents? The statement of account of solvency and LLP immediately preceding financial year is required. Particulars of document respect of the scheme of commitments of financials as to how you are going to pay off the suppliers or creditors, maybe secured creditors or unsecured creditors, how you are going to pay off so that they are not prejudiced, their interest is not prejudiced, and how the company also, I mean, the LLP continues its business, and sometimes there is a question of protecting the employment of so many people. So we have seen in the past that the government is more tuned towards protection of the employment as well as the business of the unless there is some malified intentions or something like that, then only they will wound up. Otherwise, they will continue the LLP. So a merger, I have already told you, there can be a merger between the two LLP, or it can be a demerger between the two LLP, which is permissible under the and Ahmedabad bench of NCLT said that no, there cannot be a merger between LLP and a Companies Act, so it cannot be permissible, which I mentioned to you earlier. Strike off and winding up and dissolution of an LLP. Now, strike off. Before I go into that, one more, let me share with you one more thing. Under FEMA, earlier, LLPs were not permitted to have any foreign investments earlier. But with the widening of the foreign exchange management base and opening up of various things, FEMA has become more liberal now. And there is a scheme under non-debt rules where there are two types of investments possible under an LLP. One on a non-repatriable basis by a non-resident Indian OCI, where they can invest into any LLP as a capital contribution and no conditions attached. There are no sectoral caps or nothing. Even if there's a sectoral cap, also they can invest into that particular LLP. So no conditions in that. And but only condition is that the money cannot be repatriated outside India once, I mean, the profit and the capital cannot be taken out. So that is the only condition. As far as the other scheme is concerned, all person resident outside India, it could be a foreign company, it could be a foreign citizen, it could be a NRI, it could be OCI, or it could be a foreign trust. Anybody, they can invest into an LLP's capital on a repatriation basis. Of course, there are conditions that this particular LLP's business is into the sectors which do not have any sectoral caps. That means 100% allowed. And not only that, there are no performance-linked conditions on those sectors. In those situations, those entities can invest into this particular LLPs, and the profits and their capital can be repatriated outside India. So this is a kind of benefit. Earlier, people were not going for LLP only on the grounds that they wanted a foreign capital. They have to go for a private limited company. They could not go to LLP mode. But with this, in 2019, this for non-debt rules have been amended, I mean, introduced, and that has permitted this particular provision. And because of that, the foreign exchange liberalization has happened. And because of that, now the LLPs are also a good positive mode of vehicle. Strike off, winding up, and dissolution. Now, when there is an LLP and that LLP wants to be dissolved or wound up, before that, the registrar himself on its own can strike off. In recently it has happened in the case of companies. I think about 30,000 companies were strike off on one stock, one day. Why? Because they had not filed their annual returns or balance sheet or whatever filings were pending for about 2 years. If it is more than 2 years, then they had struck off all those companies in one shot. And those companies had the tough time to get it revived. They had to go to NCLT, spend huge amount of money. I know some companies, small companies, they had somehow missed out filing for 2 years. They had to spend huge amount instead of whatever the filing fees. It was more than 4 to 5 times they had to spend on the NCLT proceedings, engaging a lawyer and all that, and getting and it took about 1 year to get it reinstated. So even the directors will be disqualified. Similarly, here now there are provisions here that if you are not operating, or there is a defunct, if the registrar feels that this LLP is not doing any business or operating, or they are not filing you are doing any compliances for more than 2 years, then they can be struck off on its own, voluntary. I mean, on its own without. I mean, of course, in case of a companies, they were not even given a notice. But one day they found that they are struck off. So this is possible even now in the case of an LLP. So if the overdue, of course, when they are striking it off or when you are winding it up, you have to file all the overdue forms and complete it. There should not be any unsatisfied charge. But here in those 30,000 companies, fortunately, some companies were left out. The reason is there were some unsatisfied charge. So those companies were not struck off. Even in the case of those 30,000, they did not strike off those companies where there were charges outstanding. And although they had defaulted for 4 years, 3 years in filing those forms, of course, they were given notices that directors were disqualified, but they had not disqualified the company. They have not strike off the company. So here also it is very important that when there are open charges, those LLPs will not get strike. So these are the conditions for strike off. And now modes are winding up. There is a voluntary winding up and by the tribunal. You can yourself go for a voluntary winding up if you don't need this LLP. Your business is over and now you want to close down this because you don't want to keep complying with the LLP on a year-to-year basis. So you can go for a voluntary winding up, or the tribunal also can wind up if they find that there is something wrong with the LLP. They can tribunal himself on their own suo motu can wind up. If there are any creditors, winding up, like, in companies, there is a creditors winding up. Creditors can issue a notice for winding up. If their dues are not paid, they can go to NCLT and then NCLT will order for winding up if you are not in a position to pay off the dues. If they have acted against the interest of the sovereignty of India and the integrity of India, if there is something which is anti-national, the LLP is doing, then the NCLT can wind up this. If the partners if they've reduced below 2 partners for more than 6 months and you don't appoint another second partner, then also the NCLT can wind up this LLP. Now the penalties. Penalties are, earlier there were huge amount of penalties for LLP, and I know one of my client who had somehow defaulted earlier, and they came to us and saying that they have run up a huge bill of penalty, and it went into 40-50 lakh rupees, and there was no choice. Subsequently, some amnesty had come, and then in the amnesty they had paid off. But the penalties have now been reduced considerably compared to what it was earlier. But still, the penalties are pretty high compared to a organization which is supposed to be a small organization, a family-owned organization. The penalties are very high, but it is there. But you have to comply with it. If you don't comply, then yes, you have to pay the price for it. So if there is a minimum number of designated partner is not maintained, then it is a 10,000 rupees, and a continuing contribution is there. Further penalty of 100 rupees per day, which is maximum can go up to 1 lakh. There earlier, the limit of 1 lakh was not there. It kept on adding up. So now they have put in a maximum cap, and 50,000 for every partner of such limited partnership who has violated. Who is fraud transaction, 50,000 to 5 lakh rupees is the penalty. Then we have got books of accounts not being maintained. So 25,000 to 5 lakh rupees in each partner, designated partner, because they are responsible for maintaining books of accounts. So 10,000 to 1 lakh rupees for each partner. Liability for misstatement in an LLP Act, again, is a fraud. So for that, again, 5 lakh rupees is the maximum penalty that can be levied. Or there is also an imprisonment if there is a misstatement, because they don't encourage such kind of misstatements. Annual return, if it is not filed, again, then there is a penalty extend up to 5 lakh rupees. See, there is something which is there. So 25,000 minimum, and it can be 5 lakh rupees. And again, partners will be individually paid 10,000 to 1 lakh. So it is a huge amount of penalty. Now, if you see this chart, then there is an additional fee payable for smaller LLPs. I told you that there is a slightly discount to the small LLPs compared to the additional fee payable to the other than small fee. There is a penalty for 100 per day for 8 and 11 not being filed. So as far as the period of delay up to 15 days, same for both. But when it comes to 15 days to 30 days, in case of a small LLP, it is only 2 times of the normal filing fees, whereas in case of an other than, it is 4 times the normal file. That means if it is 100, it is 400 rupees per day. And after 30 days, it becomes 8 times. So 800 rupees per day you continue to pay. So here it is 50%. You get a 50% discount as far as the small LLPs are concerned. Similarly, everywhere there is a 50% discount to the small LLPs compared to the other than the small LLPs. Now, Companies Act, what they have done is I told you earlier also, certain provisions of the Companies Act, they have made it applicable to LLP. There is one section 90, I already discussed, significant beneficial ownership of the company. They have changed the word shares to contribution, because actually in the LLP, there is no shares, there is only contribution. In case of a company, they have made it limited liability. So only the word changes are there, but whatever sections applicable to Companies Act, Same thing is applicable to all the provisions are applicable to LLP. I've already explained you SBO, so I don't want to take up much time on that. Disqualification of appointment of directors, we all know 164, 164(2), where if the accounts are not, if they are in the directors in a company which is defaulted in filing some documents with the ROC for 2 years, then they are disqualified. Once they're disqualified for other directorship also. So here you have to mention whether they are disqualified from being appointed as a director. So they have to give a declaration to the company or an LLP saying that they are not disqualified. Similarly, now a designated partner who is in the similar capacity as a director will also be disqualified in case if there is a default in filing. Suppose if he is a designated partner in another LLP which has defaulted in filing any documents, then this disqualification will apply to this particular LLP also. So you have to take a declaration when you are signing a balance sheet of LLP. You should also take a declaration from this designated partner whether he is disqualified from being appointed as a designated partner. And there is that, and of course, there is a limit of 20 designated partner. A person can become designated partner only in 20 LLPs. He cannot be a designated partner in more than 20 LLPs, like how it is there in the case of companies. He can become a director in only 20 companies, not more. So similar provision is here also. Powers to call for information and inspect books of accounts are same applicable as applicable under the Companies Act. Now we go to the last section of the income tax implications. Now, income tax implications basically between the difference between a company and a LLP is the LLP is considered as a firm. So whatever partnership firm and firm has got a similar thing. So there is no change. So I'm not comparing partnership firm with LLP because it is a firm as far as income tax is concerned. But there is a comparison with the private limited company or a company's structure as to what is the tax rate difference. Now the LLP pays a tax of 30% on these profits, plus surcharge, which has been discussed later, and stays at 4% on the tax plus surcharge. Now surcharge up to 1 crore is nil, and after 1 crore and the income exceeds 1 crore, it is 12% flat. So you have to suppose if your income is 5 crore, so you pay 30% plus surcharge of 12%, and on that there is a cess of 4%, which is on 30 plus 12 and whatever is around 4%. We all know it. I don't think we have to discuss that. Profit will be hands in the LLP and not in the hands of partner. We said pass through, there is no double tax. Minimum alternate tax does not apply to LLP, it applies only to companies. But there is an alternate minimum tax which applies to LLP also. When there is some deductions under Section 80 or something which is available by the LLP, then there is a alternate minimum tax. Now, as I already told you, it is considered as a firm. Now, so accordingly, the interest to partners and salary to partners as applicable to a firm, 40B applies up to 3 lakh rupees, 90%, and beyond 3 lakhs, it is 60% of the book profits. It's eligible for deduction as a salary working partner. Again, it has to be defined under the LLP document who are the working partners. How the working of the salary is to be done has to be clearly defined. You don't have to just say that, oh, any salary mutually decided. No, you will not get deducted. It has to be specifically the working, the formula, everything has to be given as to how the remuneration will be worked out, how it will be shared, who are the working partners. If it is not defined, and from the date it is defined, it will be applicable. Suppose if you amended the partnership bill in 1st of October 23. So from 1st October 23 to 31st March 24, you will be able to pay salaries. Prior to that, you will not be able to pay salaries if that provision was not there in the earlier. So it is only from this date it can be not be retrospective, it has to be prospective. Similarly, there is an interest up to 12% you can pay to the partners. Similarly, if the partners have borrowed from the firm, it will be charged 12%. So it will be both ways. Now, 45(3) is very interesting. Any person who introduces the capital, as I told you, capital can be introduced by in kind. Suppose if a partner has introduced something in land as a contribution. Now, how do you tax it in the hands of a partner who has brought in? Whatever is the book value which has been recognized and the value at which it is recognized in the books, whatever value, that value will become the sale value for the purpose of in the hands of the partner. Now, here there is a slight gray area as far as 50C or that 43CA is concerned, whether it is lower than the stamp duty value, then what happens? All that is a question mark. But generally it is advisable that it should be at least minimum at the stamp duty value, because if it is a stamp duty value, then you are complying with 50C and 43CA also. So then there is no question of any tax on 56 or tax on 53, 50C or 43CA. So in that situation, whatever is the value which is recognized in the books, that will be considered as a sale value. There are judgments which are saying that if a specific provision is there, general provisions don't apply, but there are some judgments which contradict that also. So you have to look at it from that angle. Now, let's say I've given an example. If the introduced land at 10 lakhs books value LLP ready reckoner is 50 lakhs, FMV is 60 lakhs, the sale value in the hands of will be 50 lakhs, because we have recorded in the books at the ready reckoner value of 50 lakhs. So you will be, the person who is brought in as a partner will be taxed at 50 minus 10. So you will be paying tax at 40 on 40 lakhs. Any amount in excess. There is also one more thing about a retirement. Earlier, the retirement provisions were when you retire and you get something more, that was under capital gains. But now it has been brought in under 45(4) specifically. An amendment has come in. Any payment made in excess of the capital to the partner on retirement, that excess amount will be taxed in the hands of the LLP. LLP will have to pay the tax at the capital gains at whatever is the rate. Suppose if it is the tenure of that particular partner in the firm is less than 2 years. Now long term is 2 years. Earlier it was 3 years. So if it is 2 years, then it will be considered as short term. Otherwise, if it is more than that, it will be considered long term. And if it is long term, then of course the rate is 12.5%. Otherwise, it is 30%. So the amount of tax paid in the excess of the capital may be added to the cost of fixed. And now here there is again some judgments are there. In fact, the section there is a provision also. There has been notification also. If that amount which is paid in excess, suppose for example the capital is 50 lakhs and the retiring partner is paid 60 lakh rupees, 10 lakh rupees, if it is attributable to any asset. Suppose the company has got only, the LLP has got only one asset in the books, and that 60 lakhs you are getting is because of the increase in the value of the asset, and it is valued based on the asset's value, then that 10 lakh will be added to the cost of that asset, so that the LLP can subsequently, when it sells, will be able to get a deduction. Otherwise, there is no deduction to the LLP. It's only taxable at one level, there is no deduction. And if there is an asset being distributed, you would apply section 9B. There is one simple example I have given. I'm just got about 5 minutes left. I will try to complete it within 5 minutes, and then we'll take questions. FMV of land is 50 lakhs. There is a index cost, ignoring the index value, because now you have got an option of ignoring index value. 40 lakhs is the book value of the land. 10 lakh is the appreciation on that. 12.5% is 1.25 is the capital gains on this. So the amount of attributable to the partners, the profit is 8.75. And this 8.75, that 1/4, suppose if it's a 25% partner, it will be 2 lakh will be added, and his capital in this this is 60 is 10 lakh is a capital, and if he receives 60 lakh rupees in terms of the money from the asset as well as money, then on that differential 48 lakhs, it will be paying a tax of 12.5%. Now, if there is a 72A, if there is a losses incurred by a company and that company gets converted into an LLP, that LLP can carry forward that loss and set off against the unless now there is a condition. If that condition is 51%, not more than 50% the partner should retire. So if they retire after 1 year or 2 years after set off, that becomes an income in the year in which that condition has been violated. So in the third year, suppose if there is a change in the shareholding and the 51% has been changed, so in that year the profit will be taxable. Whatever was considered exempt whatever set off has been claimed, that set off will become taxable. So there are the conditions which conversion for companies, that all assets and liabilities have to become the assets and liabilities of the LLP. So all the shareholders of that have to become the shareholders of the partners of this LLP. The shareholders do not receive any consideration or benefit other than their share in the contribution in the LLP. Then their 50% or more partners will not change during 5 years. If there is a change, then that whatever benefit you got, whatever exemption you got, will be lost and will be taxable in the year of conversion. The sales and gross receipts of the company for the last 3 years should not be average, should not be 60, should not exceed 60 lakhs. and in case of the assets, should not be in the 3 previous year preceding the financial year, should not be more than 5 crores. So if you have to see, suppose if you are converting it in year 23-24, you have to see 31st March 23, in earlier 3 years, that average asset should not be more than 5 crores. If it is, then you cannot, I mean, the conversion will not be exempt under this particular section. MAT credit is not allowed. If company has got a MAT credit, of course, that will lapse and you will not, the LLP will not be able to carry forward. Now, whatever is the cost of asset for that company will become the WDV for the block of the date on the date of the conversion. So deemed dividend provisions are not applicable to the LLP. We all know it is applying only to the company because there is no question of deemed dividend provisions under the LLP. With this, I think I've covered the LLP sections in total. And if there are any questions, I'll be willing to take it.
Yes, sir. Good evening, sir.
Good evening. Yes.
Yes, sir. We have received few queries.
Yes.
I'm just putting forward before you, sir.
Yes.
The first query that we have received is, sir, an LP is being converted to a company.
Yes.
Can the current account balances of the partners be treated as unsecured loans due to the conversion?
Okay, I will answer this. See, the point is, whatever was their capital, share capital. I mean, see, sorry, LLP is converted to company or the company is converted to LLP?
Sir, LLP is being converted to a company.
To the company. LLP is converted to the company. So whatever is the capital, which is the fixed capital, will become the share capital of the company. And whatever is the unsecured, I mean, whatever is the current account or debt can become unsecured loan. But here you have to comply with section 73. If they are shareholders, then there is no issue.
The next query that is there is, how stamp duty is calculated in this based on capital contribution?
Yes, it all depends. See, there is a stamp duty on an LLP agreement, but that all is a state subject, and each and every state has got its own rules. Here it is, I think, 0.0025% of the capital. So it is up to, I think it is 50,000 rupees. It is 500 rupees. The moment it goes to above 50,000, it is 1,000 rupees. Maximum is 15,000 as far as Maharashtra is concerned. So each state has got its own rules. We'll have to find out from each state. I know about Maharashtra. The maximum is 15,000 as far as the stamp duty is concerned. It starts with 500 stamp duty.
So next query is, can a member of ICAI with certificate of practice and who is partner in a partnership firm LLP or LLP with other CAs also be a partner in another LLP involved in the financial or managerial advisory profession, whereas all other partners in the second LLP and non-CA?
No. Our institute code of ethics will not permit you to become partner, because here, see, he can become director in a company. That is allowed. He can become a CEO or CFO of any other company. But here, being a partner, our LLPs are also accepted mode of a partnership in our practice. So I don't think it will be allowed as under code of ethics to become partner with a non-chartered account.
The next query is, if an LLP is being converted to a company, can the current account balances of the partners be treated as an unsecured loan because of the conversion process?
That I already answered, the first question.
Yes, sir. It is the same one, sir. Almost related to the same
Yes,
nature.
same.
Yes, sir. So this was the query that we have already taken forward before you, sir, whatever we have received so far.
Yes.
And sir, already the time is being done, and thank you, sir, for being with us. And it was a wonderful session. And even we hope that even our viewers had find today's webinar both enlightening as well as inspiring. So various insights for aspect were discussed by you, sir, on the legal requirements from its formation till the winding up process, sir, and that to taxation aspect also.
Yes.
So I thank you on behalf of the entire Corporate Laws and Corporate Governance Committee, and I extend my heartfelt gratitude to you, sir. And your insights and expertise have truly enriched our experience today. And to all our attendees, thank you for your enthusiastic participation and engagement. So once again, thank you to everyone. Thank you to you, sir.
Thank you very much. Thank you. Thank you, Nishana. Thank you.